Welcome to the Deep Dive, your way to get up to speed without waiting through hours of earnings calls.
We do the waiting for you.
Exactly. Today, we're jumping into the second quarter 2025 conference call for Inspire Medical Systems. It happened right after the U.S. market closed on August 4th, 2025.
And boy, did it cause some fireworks, a really dramatic market reaction.
Totally. So we're going to unpack the main numbers first, then we'll really dig into what management said that seemed to spook investors so much.
Yeah, and look at the immediate aftermath. Try and figure out what's really driving the story for Inspire right now.
It's a fascinating situation, that disconnect between the numbers and the reaction.
Absolutely. It's almost a case study, How can beats on paper lead to a stock falling over 30%?
Right. It shows you got to look beyond just the headline figures sometimes.
Forensic thinking, almost.
Yeah.
The numbers only tell part of the story.
Okay, so let's start with those Q2 2025 numbers. Because like you said, at first glance, they might not explain the panic.
Go for it.
All right. Inspire reported a GAAP diluted EPS loss of $0.12. Now, GAAP is, the standard accounting method.
Generally accepted accounting principles.
Right. That $1.12 loss was actually better than expected. Estimates were for a $0.15 loss, so it was a $1.03 beat.
Okay, so far so good.
Exactly. But then the non-GAAP, or adjusted EPS, that was the real standout. It came in at $0.45.
Wow, okay. And the consensus?
The consensus was only $0.22. So they beat that by like 104%. Huge beat on adjusted earnings.
That adjusted figure usually pulls out things like stock comp, one-off charges, right?
Yeah.
It's supposed to show underlying profitability.
Precisely. Gives you a cleaner operational picture. And then revenue.
Revenue was $217.1 million. That was also a beat, but just barely. Less than 1% over consensus.
Still, it represents 11% growth compared to last year.
Which isn't terrible on its own. Gross margin was solid too, 84.0%.
Though down slightly, about 80 basis points year over year.
Right. And adjusted EBITDA, that's a good proxy for cash flow, was $44.1 million. Plus, they finished the quarter with a decent chunk of cash, $410.7 million in cash in investments.
So you line all that up. JAP beat, massive adjusted EPS beat, slight revenue beat, solid margins, healthy cash.
You'd think, okay, maybe a flat day, maybe up a bit.
Right. But no, the market reaction was, well, brutal. Shares plunged over 32% by the close of the next trading day.
And the volume was insane, something like 20 times the average.
Yeah, huge volume.
Yeah.
And tons of put option activity. Implied volatility shot up to the 95th percentile.
Which basically means the market was suddenly pricing in extreme uncertainty, huge potential swings.
So how do we square that circle? Decent numbers, market panic.
It all comes down to the commentary.
Yeah.
What management actually said on the call that provided the context that just overwhelmed the numbers.
Okay, so let's get into that. What did the CEO, Tim Herbert, say?
Well, he started off acknowledging, the good start to 2025 hitting milestones, standard stuff. But then he pivoted pretty quickly. He talked about needing to provide, quote, important context on the challenges they were facing.
The challenges part. Never what you want to hear foregrounded.
Especially regarding the rollout of their new Inspire V system that just started in May. He said straight up, the U.S. rollout is progressing slower than expected.
Slower than expected. Okay, that definitely lengthens the transition timeline. Did he say why? What are the specific headwinds?
He did. He laid out several key issues. First, training and onboarding delays.
For the medical centers using the device.
Exactly. A lot of centers just haven't finished the training, the contracting, and crucially, implementing something called SleepSync.
SleepSync? What's that?
Think of it as the software backbone for the new Inspire V. He said it's not technically hard, but getting it through hospital IT approval processes is taking way longer than they thought.
The classic IT department hurdle. How many centers are actually up and running with it?
Just over half in the U.S. so far. So a big chunk aren't fully ready for Inspire V yet.
Okay, what else?
Then there was reimbursement friction. Specifically with a new CPT code. That's the billing code for Medicare patients. Code 64568.
A new code needed for the new device.
Right. It was approved, even retroactively to January 1st, 2025. But the actual software updates needed for centers to submit claims using that code, those weren't active until July 1st.
Wait, so for the whole first half of the year, basically centers couldn't properly bill Medicare for Inspire V?
Pretty much. So they just kept using the older Inspire 4 system for those patients, created a real bottleneck.
Okay, that makes sense. What other factors?
Patient waiting. Kind of ironic, but knowing the new Inspire V was coming, some patients just decided to wait for the upgrade instead of getting the Inspire 4.
Understandable from a patient perspective, but hurts near-term numbers.
Definitely.
Yeah.
Until those centers fully switch over.
Yeah.
And then the big one everyone's talking about, GLP-1s.
The weight loss drugs. Zepbound, Wegovy.
Yep. Management thinks some patients are putting off Inspire therapy to try these drugs first. So short-term cannibalization of their pipeline?
But they tried to spin it positively long-term.
They did. They framed it as a potential tailwind long-term because patients might lose weight on GLP-1s and then qualify for Inspire.
That's an optimistic take. But isn't the worry that these drugs might just permanently reduce the need for Inspire in a big chunk of the obese population?
That is precisely the market's fear and why this became such a focus. Is it just a delay or is it a fundamental demand shift? Management sees a path after weight loss, but the market's worried about how many actually take that path versus staying on GLP-1s. Or maybe the drugs even resolve their sleep apnea.
It feels like a major structural question, not just for Inspire, but for any medtech company dealing with conditions linked to obesity.
Absolutely. It's forcing a reevaluation of long-term growth potential across the space, a potential repricing event.
So external headwinds, but also some internal decisions impacted things. I thought I heard something about marketing.
You did. They called it a strategic marketing pause. Basically, they intentionally pulled back on patient marketing and expanding their footprint in the first half of the year.
To focus resources on the Inspire V launch.
That was the rationale, like hitting the brakes to refuel, hoping to accelerate later. They say those efforts are ramping up now for the second half.
Okay. And one more thing. Inventory.
Yeah, a $2.1 million charge for excess Inspire 4 parts, and burning through that old inventory will be another drag in the second half.
Okay, so quite a list of challenges. Training delays, IT issues, reimbursement hiccups, patient waiting, GLP-1s, marketing pause, inventory.
Yeah, put it all together.
And it leads to the guidance cut, which is pretty shocking.
It really was. For-year revenue guidance got chopped to $910 million.
Down from $955 million previously. That's about a 4% cut at the midpoint. Still implies 12-13% growth for the year, but a big step down from expectations.
But the earnings guidance cut was the jaw-dropper. Diluted net income per share for the full year. Slashed.
What was the new range?
$42 to 50 cents per share.
And the old guidance.
$2, $20, and $2.30 per share.
Wow. That's massive. Over 80% reduction at the midpoint.
Huge. They said it was mainly the lower revenue plus higher marketing costs now kicking in. And importantly, that new $40 to 50 cents range includes a one-time non-cash charge of about $2.57 per share.
For what?
Accelerated stock-based comp and some legal fees. So the underlying operational profit outlook took a massive hit even before that charge.
But they kept the gross margin guidance the same, 84-86%.
Yeah, they held that steady. But the outlook for Q3 revenue was also pretty weak, only expected to grow 1-3% sequentially from Q2. Signals these transition issues are definitely continuing.
Okay, so huge guidance cut, yet you said management sounded confident. How do you reconcile that? Is it just putting on a brave face?
Well, that's the million-dollar question, isn't it?
Yeah.
You can see why the market's skeptical. But they did point to specific actions they're taking.
Like what?
They're throwing technical teams at accelerating that SleepSync rollout, aiming to get most centers done by the end of Q3.
And the Medicare billing problem is fixed now, right? Since July 1st.
Correct. That's a major bottleneck removed, theoretically opening up the Medicare patient flow again.
And they're hitting the gas on marketing and expansion now.
Yep, ramping up patient marketing and aiming to add over 150 new centers in the second half. That's ambitious.
Are there any early signs the Inspire V device itself is performing well where it is being used?
There are some positive data points. An early study from Singapore showed surgical times cut by 20% with Inspire V.
Faster procedures mean more capacity.
Exactly. And they said U.S. centers that have fully transitioned are seeing over 20% increases in patient implants compared to the year before. So it suggests improved efficiency once the hurdles are cleared.
So the core product might still be strong. What else are they doing?
Investing in R&D, about 8% of sales. They mentioned working on sensing algorithms and pediatric uses. Looking ahead.
Future growth drivers.
Right. And the proposed Medicare reimbursement rates for 2026 actually look pretty good. Increases for hospitals, ASCs, and surgeons.
So the payment environment looks supportive longer term.
Seems that way. They also mentioned a manuscript submitted for publication about a predictor algorithm.
What would that do?
Potentially eliminate the need for a diagnostic procedure called dissects for many patients, based just on BMI and neck size. That could really streamline things if it works out.
Make it easier for patients to qualify. Interesting. Any leadership changes?
They announced the retirement of their EVP, Randy Ban, for January 2026, but stressed a smooth transition is planned.
And looking further out to 2026 growth.
Management was quite emphatic. They said they absolutely expect revenue growth next year to be higher than the 12-13% they're guiding for this year.
Reinforcing their message that these are temporary operational issues, not a permanent slowdown.
That's the message they're pushing. But clearly, the market isn't buying it wholesale just yet.
No kidding. This call really feels like a turning point. That gap between management's confidence and the market's reaction is huge.
It's critical. The market heard guidance cut and GLP-1s and immediately priced in structural problems, not just temporary ones. That's why you saw multiple downgrades from analysts at Leerink, JP Morgan, Truist.
All citing what?
Things like growth visibility deterioration. Basically, they can't confidently predict the future growth path anymore.
So for you, the listener, this means Inspire has shifted into a show-me story.
Exactly. Investors need to see the proof. They need concrete evidence that Inspire V is gaining traction and that the company can handle the GLP-1 dynamic before confidence returns.
And the stock performance reflects that uncertainty. It's massively underperformed peers, down like 46% in 1 month, 57% in 3 months, 60% over the year.
While the broader med device ETF, like IHI, was basically flat or even up slightly over those same periods, huge divergence.
That GLP-1 issue really seems to be the elephant in the room. Management tries to frame it as a potential long-term positive, but the market sees it as a new structural threat.
Absolutely.
Yeah.
It raises fundamental questions about future demand for sleep apnea devices, especially for the large segment of obese patients. The narrative has shifted.
So if you're watching Inspire, what are the key things to look out for, the potential catalysts?
Number one is the actual Inspire V rollout metrics. We should get an update with Q3 results in early November. That's crucial.
Okay.
Also, there's an FDA panel in September about pediatric use reimbursement. That could open a new market.
Potential publication of their long-term 5-year DREAM registry data could also help validate the therapy's effectiveness.
Definitely. And just getting more clarity on how payers handle GLP-1 coverage and how that affects patient choices. Those are the things that will show if Inspire can rebuild trust or if it stays in the penalty box.
The story has clearly gone from hyper-growth to, what'd you call it?
Defensive recalibration.
Right. Okay, let's switch gears for a second. Time for our This Is Not Financial Advice segment. Let's pretend we're hedge fund analysts pitching an idea after this call.
Okay, putting on my hypothetical hedge fund hat. Remember, everyone, just a thought experiment for experienced folks, not advice.
Got it. So the stock just cratered. Implied volatility is through the roof 95th percentile, meaning options are pricing in massive moves. Management says temporary, street says structural. Big disagreement. What's a pitch?
Given that setup, my pitch is to sell an out-of-the-money call spread.
Okay, break that down. Example.
Sure. For instance, maybe you sell the INSP 95 strike call option and at the same time buy the 100 strike call, both expiring relatively soon.
And the logic. What are you betting on?
You're betting the stock won't surge dramatically past those higher levels, 95 or 100 in the short term. You collect the premium from selling the spread, capitalizing on that super high implied volatility caused by the panic.
So the plausible argument is stock is beaten down, maybe it bounces a bit, but sentiment is awful, guidance is weak for Q3. A massive, quick V-shaped recovery back above, say, 95 seems unlikely right now.
Exactly. The market needs to be shown proof, remember? That takes time. This strategy bets that the path of least resistance near term is sideways or maybe drifting down slightly, not a rocket ship higher. You collect premium while you wait for more data.
And the outrageous part.
Well, you're selling calls on a stock that just dropped over 30%. If management somehow does turn things around super quickly, or sentiment flips on a dime, or some unexpected positive news hits.
You could lose money on the trade. The stock could blow past your short strike.
Right. It's aggressive because you're betting against a sharp recovery after a huge drop. But that sky-high implied volatility makes the premium you collect very attractive if you believe the recovery will be slow and bumpy, not immediate. It's a play on elevated fear premium decaying.
Interesting. A high volatility, contrarian-ish bet that the bad news sticks for a little while longer.
Okay, hypothetical hat off now.
Hat off.
So wrapping up our deep dive on Inspire Medical's Q2 2025 call, we've seen a company really wrestling with a complex product launch, plus these new market forces like GLP-1s. Yep. The headline numbers, especially adjusted EPS, look good on the surface, but the market reacted violently to that big guidance cut and the reasons behind it.
Viewing those operational headwinds as potentially structural, long-lasting problems, not just temporary glitches.
Though management is pushing back hard on that, they're confident, they point to Inspire V's benefits, they've outlined clear steps to fix the rollout issues and navigate the GLP-1 landscape.
The narrative has shifted, though, from that hyper-growth story to, as you said, defensive recalibration. They have to prove themselves all over again.
They really do.
So the question for you, our listener, is clear. Do you believe management? Will their actions fix the problems and get growth back on track? Or will this show-me story drag on as they face these new challenges?
It's a compelling situation with big implications, not just for Inspire, but for how you think about innovation and disruption in the whole med tech sector. Sometimes the disruptors come from unexpected places.